Hey everyone, and welcome. Today we're going to decode the two major financial languages that companies all over the world speak, US GAAP and IFRS. If you really want to understand how global business works, you've got to know these. So let's jump right in. All right, so let me just start with a question. Is it possible for two companies, identical companies, with the exact same sales, the same assets, the same operations, to look completely different on paper? The answer, believe it or not, is a huge yes, and it all boils down to which accounting rulebook they're playing by. Okay, so here's our game plan for this explainer. First, we're going to meet these two languages. Then, we'll get into the big divide between them. It's all about rules versus principles. After that, we'll see how these differences actually play out in the real world, why this stuff matters so much, and finally, we'll take a peek at what the future of reporting might look like. All right, first up, the two languages of business. Let's get to know the world's two dominant accounting standards. So on one side of the ring, we've got US GAAP. That stands for Generally Accepted Accounting Principles. The folks setting the rules here are the Financial Accounting Standards Board, or FASB for short. GAAP is famous, or maybe infamous, for being super detailed and rules-based. It's the law of the land for all public companies in the US. Then, on the other side, you have IFRS, which is International Financial Reporting Standards. The ISB sets these rules, and they take a much more principles-based approach. And yeah, as the name kind of gives away, it's what most of the rest of the world uses. And this really shows you the lay of the land, right? You can see that while US GAAP is king in the massive US market, IFRS is pretty much the standard everywhere else you look. Europe, Canada, Asia, you name it. And that's exactly why you need to get a handle on both in today's global economy. Okay, so let's get to the real heart of the matter. This is the core divide, the fundamental philosophical difference between these two. And it really all comes down to one thing: rules versus principles. And there's a great analogy for this that makes it super clear. Think of US GAAP as a really, really detailed recipe. I'm talking exact ingredients, down to the gram, precise cooking times, specific temperatures. You just follow the instructions step by step. IFRS, on the other hand, that's more like a master chef's technique. It gives you the end goal, like create an amazing sauce, and it teaches you the core principles of cooking, but it trusts your professional judgment to actually make it happen. So to put it a bit more formally, GAAP is this massive rule-heavy framework that's loaded with super specific guidance, often for different industries. IFRS, though, is built on a broader conceptual framework. It's designed to give accountants the flexibility to use their own judgment so that the financial statements show what's really going on with the business, the economic substance, not just what the legal paperwork says. Okay, so that's the theory. But how does this whole philosophy actually change the numbers you see on a financial statement? Let's take a look at some key differences in action. This table breaks down some of the big ones. So first, let's talk inventory. GAAP allows something called the last in, first out, or LIFO method, but IFRS says no way. Now, why does that matter? Well, when prices are going up, using LIFO can make a US company's profit look lower than an identical company on IFRS. It's a huge deal. Okay, next up, development costs. We're going to dig into this one in a second, but basically, GAAP usually makes you expense those costs right away, while IFRS often lets you capitalize them as an asset. That can really boost your short-term profit. And finally, asset revaluation. With GAAP, things like buildings are usually kept at the price you paid for them. But under IFRS, you can often revalue them to what they're worth today, which can make a company's balance sheet look a whole lot stronger. But to really see just how big the impact can be, let's zoom in on that one single difference: how a company handles its development costs. Honestly, this one is a total game changer. Okay, so let's imagine a software company. They spend $5 million developing a brand new product. That's the setup. Same company, same $5 million out the door. Now, just look at this chart. It's wild. Under US GAAP, that whole $5 million hits the income statement as an expense. Right now. Boom, your profit is down by $5 million. But under IFRS, if that spending meets certain criteria, it's not an expense at all. It gets capitalized, which means it becomes an asset on the balance sheet. The immediate hit to profit? Zero. So think about that. Same company, same spending, but a $5 million swing in reported profit. That is a massive difference. So, this brings us to the big question. Why does any of this actually matter? What's the real-world impact for someone like an investor or an analyst? There's a quote that just frames this perfectly. It says, "Comparing a US company to a European one without adjusting for accounting differences is like comparing marathon times without knowing one runner was on a treadmill." And that just nails it, right?
If you're not paying attention, you're not making a fair apples-to-apples comparison at all. You could be totally misjudging a company's performance simply because of the accounting rules they follow.
So, for anyone out there who's analyzing a company, this is absolutely crucial stuff. First, you've got to normalize the numbers if you want a true apples to apples comparison between peers. But it goes way beyond that. Think about it. These differences can affect whether a company is in compliance with its bank loans or whether the CEO gets their bonus. It directly messes with valuation models, potentially changing a company's worth by millions. And it can even change how you look at cash flow, since IFRS is more flexible on where you classify things like interest payments. And that brings us to our final section. In a world that's divided, what does the future of financial reporting actually look like? Well, for years now, there's been this huge effort to try and merge the two standards. It's a project they called convergence. And honestly, they've had some real wins. The rulemakers from both sides got together and managed to align the rules for huge topics like revenue recognition and leases. And that's gotten rid of some of the biggest pain points, for sure. But, and this is really the key thing to remember, even with all that progress, that core philosophical divide we talked about, it's still there. That detailed recipe versus the master chef's technique, that fundamental difference in how they approach things hasn't gone away. And that means we're still going to have some pretty big gaps between the two for the foreseeable future. Which really leaves us with this one big, thought-provoking question. In a truly global economy, one that's more connected every single day, will we ever get to a point where we all speak a single, universal financial language? Or are we always going to need skilled translators to help us decode the world of business? Well, that remains the central challenge. Thanks so much for joining me.